Before you start looking at dream homes online, let's talk about getting your finances ready for the biggest purchase of your life. Think of this as building a strong foundation before constructing your house. The first step is understanding where you stand financially, and that starts with your credit score. Your credit score is like your financial report card, and in California's competitive market, you'll typically need a score of 620 or higher to qualify for most mortgages. The better your score, the better interest rates you'll get, which can save you thousands of dollars over the life of your loan. If your credit score needs improvement, don't panic. You can dispute any errors on your credit report, focus on paying down existing debt, and settle any accounts that are in collections. These actions can boost your score significantly over a few months. In California, there's an additional financial twist. You'll need to factor in higher homeowners insurance rates compared to other states. This is because California is prone to natural disasters like wildfires and earthquakes. On top of that, some areas have special assessments called Mello-Roos districts, which add extra costs to your monthly expenses. Imagine it like this. You're planning to buy a house in California. It's your dream home, but there's a catch. You might also have to pay an additional amount each month depending on where the property is located. Now this might sound like an extra financial burden, but hold on a second. There's a silver lining. California offers fantastic down payment assistance programs and first-time home buyer benefits. So while the homeowner's insurance in Mello-Roos might seem like a downer, they're not the whole story. With these extra financial tools, buying a house in California could be more achievable than you thought. To really understand your financial situation, list out all your monthly expenses from rent and utilities to groceries and transportation. This will help you figure out how much money you have left over for saving and investing. Next, set some clear financial goals. How much do you want to save for retirement? How much do you want to save for your children's education? By setting these goals, you'll know exactly what you're working towards. Now let's talk numbers. Crunch some numbers and figure out your debt-to-income ratio. This is a big one for lenders. They want to see that you can handle your monthly mortgage payments without struggling. Your DTI is calculated by adding up all your monthly debts, including your future mortgage payment, and then dividing that number by your gross monthly income. Lenders generally prefer a DTI of 43 or lower. If your DTI is higher than that, don't worry. There are ways to improve it. Pay down some debt, ask for a lower interest rate, or even wait a bit and apply again later. It's time to take a closer look at your credit report. Your credit report is a detailed record of your borrowing and credit history, and it's essential for getting a mortgage. When lenders look at your credit report, they want to see that you've been responsible with credit in the past. This means making on-time payments, keeping credit card balances low, and not opening too many new accounts in a short period. You can get a free copy of your credit report once a year from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion. Check your reports for any mistakes and fix them right away. Late payments, charge-offs, or bankruptcies can stay on your credit report for up to 7 years. But don't lose hope. After 7 years, they'll be erased from your report, allowing you to start fresh with a clean slate. If you're renting right now, make sure to keep your rental history clean. Pay your rent on time and in full every month. If you have a good relationship with your landlord, ask them to write you a letter of recommendation. This can be especially helpful if you're a good tenant and have a spotless payment history. If you're planning to buy a house soon, having a strong rental history can make a significant difference in your ability to secure a mortgage and get a great interest rate. Let's chat about savings. Having a healthy savings account is key to achieving your financial goals. Start by setting a savings goal. This could be a short-term goal like saving for a vacation or a long-term goal like saving for retirement. Once you've established your goal, create a budget that includes regular savings deposits. Automate your savings by setting up automatic transfers from your checking account to your savings account. Consider opening a high-yield savings account to earn more interest on your deposits. And don't forget to take advantage of employer-sponsored retirement plans like 401(k)s, especially if they offer matching contributions. By consistently saving and investing, you'll be on track to achieving your financial dreams. Next, figure out your credit history. Your credit history is a big deal when you're applying for a mortgage. Lenders want to know how you've handled credit in the past to figure out if you're reliable. They'll look at how many credit cards you have, how much debt you carry, and how often you pay your bills on time. To build a solid credit history, start by getting a credit card and use it responsibly. Pay your bill on time every month and keep your credit utilization low. As you prove yourself to be a trustworthy borrower, you'll gradually build a strong credit history. Now let's talk about how much you can actually afford. Looking at homes online is fun, but it's important to be realistic about your budget. Don't fall in love with a home that doesn't fit your financial situation. Use online affordability calculators to get an estimate of what you can afford based on your income, credit score, zip code, and planned down payment. Keep in mind that these calculators give you a general idea, and it's always best to consult with a mortgage professional for a more personalized assessment. Let's dive into your debt situation. Your debt level is a crucial factor when applying for a mortgage. Lenders use your debt-to-income ratio, DTI, to assess your ability to repay the loan. A high DTI can result in loan denial or higher interest rates. To improve your DTI, focus on paying down existing debt, such as credit card balances and personal loans. By reducing your overall debt, you'll free up more of your monthly income for housing expenses. You can also ask for a lower interest rate to reduce your monthly payments or wait until your debt decreases. It's time to explore the world of mortgages. Understanding different mortgage options is vital when buying a house. Research various loan types, including fixed-rate mortgages, adjustable-rate mortgages, and government-backed loans like FHA and VA loans. Each mortgage has its own advantages and disadvantages. So it's essential to find the one that aligns with your financial situation and long-term plans. Shop around with different lenders to compare interest rates and fees. Getting pre-approved for a mortgage can also demonstrate your seriousness as a buyer when making an offer. Now let's discuss down payments. Down payments are usually a significant portion of the home buying process. Research down payment requirements for different loan types and explore available grants, tax credits, and other financial assistance programs. A larger down payment can help you secure a better interest rate and avoid private mortgage insurance, PMI. However, it's important to balance your down payment with your overall financial stability. By understanding your options, you can make an informed decision that suits your circumstances. Finally, let's talk about closing costs. Closing costs are the expenses involved in finalizing your mortgage and purchasing the property. These costs typically include appraisal fees, title insurance, and property taxes. It's essential to budget for these expenses as they can add several $1,000s to the overall cost of buying a house. Ask your lender for an estimate of closing costs and factor them into your financial plan. As you work toward your home buying journey, remember to check your credit report regularly, maintain a healthy DTI, save for a down payment and closing costs, and research mortgage options. By taking these steps, you'll be well on your way to achieving your homeownership dreams. Remember, getting pre-qualified is different from getting pre-approved. Pre-qualification gives you a rough estimate, but pre-approval means a lender has actually reviewed your financial documents and committed to lending you a specific amount. Always go for pre-approval when you're ready to make offers. So don't hesitate to reach out. Together, we'll turn your house hunting dreams into a reality. Thanks for watching.